Good day, investors. Today I'm bringing a more niche company, Evolution AB. Evolution AB is a global B2B leader in online casino solutions, an innovative, profitable one-stop shop for operators. They have a large moat with scale, innovation, partnerships, and strong IPs. They are focused on very disciplined capital returns to shareholders, balanced with global expansion and long-term value creation. They are extremely profitable, have zero debt, although with some risks. So Evolution AB is a Swedish company which IPO'd in 2015. If you look at some of the pictures I have here, you see the total gaming market in general is mostly land-based, although it's shifting more towards online. The casino market in specific is mostly land-based, although it's shifting towards online and adding some RNG elements. This is a growth industry. As you can see, a 5-year compounded annual growth rate for these specific areas. You see it's land-based is stagnant, slowly growing, but live casino and RNG casino are growing. So the share of these two pies up here, they're gonna overtake the current shares. They're gonna grow in importance. So what is Evolution's business model? So B2B, so it's business to business. It's not business to clients, which is great from an operational risk perspective. So you have Evolution and you have a middleman, an operator, and the end users. So the operator is taking on the operation, most of the operational risks related to the end users, which is amazing. It also makes their returns more less volatile. So it's from a business perspective, this is a huge plus. You can see it in the industry. Some other gambling companies are trying to shift towards Evolution's business model, although not as successfully, and Evolution is unchallenged. You can also see how they operate with their customers. They are a one-stop shop, everything integrated, and they provide it to their operators, who are the middlemen, basically taking on operational risks, and they do it to the players. They are really profitable. We'll see that later. Their systems are highly reliable, so that's another addition basically to their moat. They have new games coming out. They have 1700 plus tables. So this is a huge online operation. They have 800 customers, so that makes them, on the surface, if you look at that, you would say, okay, it's relatively diversified. And then you can see how they depend on customers. You can see actually from 2020 to 2024, the top 5 customer dependency rate actually went up, although the top 1 also went up, but slightly less. This is one of the, let's say, major risks for them, but it's manageable and it haven't been an issue because they are such a strong partner. From a shareholder perspective, I really like the skin in the game that you can see on the shareholder structure. First, you have Kenneth, who is a billionaire investor with global holdings. In the BAT video I mentioned, he holds around 9% of BAT and 6% of another British tobacco company called Imperial Brands. Usually when he takes over or buys into a company, he pushes management to a more pragmatic approach, focusing on profitability and buybacks and dividends. You can also see that an Evolution backer is still in the game, so still a large part of their investment, and management is actually heavily involved. And then you can see other investment funds here. I'm not gonna go through all of them. I really like to just highlight Kenneth, and since late 2024, his share actually increased from 15% to 17% as of June 30. So in that period, you had poorly received quarterly Q1 numbers where the share tanked 20%. That Kenneth didn't sell, so he bought more actually. And let's look at the breakdown. So net revenues by region. You can see that Europe is dominant, although it's shrinking in dominance, but it's still growing overall. Asia is growing both by euro amounts and by share of total revenue. North America is kind of flat, although Evolution tries to break into the US. North America right now is mainly Canada, where they are true market leaders. They want to break into the US, but it's not easy because you have to deal with regulations at the state level. So not just like one country and you have the whole nation, but you have to deal with regulators one by one. You have to open up offices sometimes to get your licenses. And then Latin America, Brazil is flat, but overall everything is growing. It's just the shares of revenue changes. And you can see that most of their revenue comes from live and some from RNG. From 23 to 24, this didn't change much. Look at their moats. So first, huge scale. Massive live casino infrastructure with studios worldwide. We'll see all the studios in a couple slides later. They hire people in cheaper labor countries like Georgia, and then they can just provide live service, live streams to developed core markets to get that wage arbitrage with the higher returns, cost advantage from scale, in-house production, right? These are like Hollywood style productions. From the innovation perspective, they are coming up with new games, game shows, apps all the time, new games. Long-term partnerships with major operators create a sticky relationships, right? They have these long-term contracts and they provide the service. Of course, they have IPs, so they have a lot of intangible assets in IPs, and they are heavily trying to enforce their intellectual property rights to maintain their licenses, not to get unlicensed operators on them. So these are huge long-term durable moats. And then on the right you can see the top live dealer software providers by games. You can see globally Evolution leads in most categories. EU also dominant. UK not in the US as said. They are just starting to expand there. Canada is huge dominance. It's undisputed. And actually you should look at, just out of curiosity, you should look at how many people, how many percentage of adults play gambled in the past year or something in Canada. If I recall it correctly, it was like 75%. So it's a shocking number. I don't know what Canadians are doing, but maybe it would be wise not to spend all your money in gambling. Just a thought. Australia smaller, but still dominant in some areas. And then Asia. Asia is growing rapidly for gambling in general, for Evolution in particular. From a management perspective, their dividend policy, since their IPO unchanged, is minimum 50% of net profits and 100% of excess cash. They have a goal target for 2025 of €500 million of share buybacks. They're expanding globally, and now you can look at the studios. You can see that they have these cheaper labor cost country studios. Yes, and in North America, with their US expansion, they are forced to open offices, which is, if you compare average salaries in Georgia, not the US, Georgia, to US, it's huge gap. So they wouldn't probably do that unless regulatory requirements force them to do. And then they are large in South America, also with studios. They are expanding, growing. Senior executive pay reasonable. You see, although I didn't find a clear, transparent incentive structure. You can see the incentive structure, but you cannot really see KPIs. Although given their history with look at their margins, right? You have their profit margins, EBITDA margins, operating margins, everything is going higher. And even if it would just stagnate at these margins, like, what do you want more? Like 70% EBITDA? Like, let's just focus on profit margins. More than 50% profit margins. This is amazing. How can you do this? Like, these are like a monopoly margins or even more. People call some companies monopolies. they don't have margins like this. These are insane numbers. They are trying to shift towards more regulated markets because they operate in gray areas, gray markets, regulated and unregulated. Although if you check out their trend, so 24, this slide kind of messed up, but for 24, 40%, 40%, 41%, so they are kind of flat, even down from 2022, the share of revenue coming from regulated markets. But in theory, they want to shift towards regulated markets, right? Because remember, regulations help the big ones, so big firms. They usually push out, ring fence against new competition. So, but they also say with new regulated markets, the margins are lower there. Well, I don't know. They didn't really push that much in other than rhetoric, and their margins are going higher. So if we see a more clear correlation that, okay, the regulated market share goes up to 70% and then the margins shift from 56 to 46, then you will see a clearer picture. Doesn't see that. They kind of operate as they are, and the margins are just growing. Let's look at their shareholder remuneration history. You can see that they had a huge free cash flow growth over the years. I think this was in the next slides you'll see. I think the compounded annual growth rate here is like 50%. Of course, you cannot grow. So if you look at to the skies, COVID was a huge boost for their numbers, but in recent years it was more like 10%-ish growth, 8%. I don't have the share price on this chart, but if you would open up the share price and look it for yourself, it spiked during the lockdowns, and then it was coming down. But if you look at valuations during the lockdowns, it grew. Like, look at this growth, like hundreds of percentage of growth are happening in these couple of years, and then it's sky highs. Like lockdowns, investment, everything goes up, which is just benefiting from the lockdowns, and the share price like shoot out. Today, it's much lower than it was during COVID. But the companies the fundamentals are just keep going up, keep improving. So the fundamentals are still strong, while the share price is went down. So it's a better deal overall, and we will see that. And then you can see they're maintaining their dividend policies, and they are adding buybacks, especially in 24, and then now they are targeting 500 million for 2025. So that would be something around here. Let's look at the margin of safety. So I see an intrinsic value of 84 euros on the company based on what? Based on a required rate of return of 10%. So that's my discount rate. And I'm using a 12% growth rate. So this is, I believe, is conservative. Why? Because the compounded annual growth rate since 2018 is 50%. And if you remember the second or third slide, the market for live casinos and RNG is growing more than 20%, 25% actually. So if I pick 12%, that's not that huge. That's relatively conservative. Look at the year-over-year growth, right? You see the COVID booms, and prior to that, 2022, 23, 25%, 24, you saw actually only 8%, and now I would say 16. I'll tell you what this is in a second. So 12% seems, I think, reasonable, and the required rate of return is 10%. It's you could adjust that higher or lower. I think 10% is even high for low volatility business like this from Sweden, which is not an emerging market. So let's look at their first half of the year numbers. You can see that actually their free cash flow, if I annualize the first half, actually dropped. But what happened is, they have tax payments, right? So if you annualize the first half, you have tax payments there, so it's gonna distort the picture. And then they had discussion. They had a dialogue with the UK Gambling Commission, which launched a formal review of Evolution's UK license, following a concern that Evolution's games were accessible in the UK via unlicensed operators. So that's always a risky area for them, for Evolution, because they have live streams. So if you have you're live streaming, you give operators access to your live stream, and if they have a license and everything, it's fine. But if somebody just gets access to your live stream somehow, cybersecurity issues, right? And they can just stream it and collect money on it without a license. So that happens. Evolution is not really to blame here. They are the victim, I believe. So that should be the outcome of this dialogue. There were waivers issues in the UK, and usually I believe they ended with, like, another example was like a 5 million fine or something, and they were actually did something bad, while Evolution is basically a victim. Also, if you look at, that's what I said for number 2, I want to look at if I adjust their income. So receivables rose from the first half to 24 by 258 million, or 69%. If I add back this amount of receivables to operating cash flow, I end up with actually 16% growth year over year if I annualize this, right? Because they in theory should collect in the second half these receivables. So I think 12% makes sense. I don't see a huge, like, oh my god, first half is horrible number. No, it's there are seasonal adjustments to be made here. And look at their strengths. So they have consistent cash generation and very high profitability. So if you look at the return on equity, 29%. Wow. If you look at their return on tangible assets, that means you remove everything non-tangible, like most of their IPs, right? They are close to 50% return on tangible assets. So basically they don't really need physical assets to operate. They don't look at their CFFO. So let's pick 24, 1.3 billion euros, and then they have a capex of 136. So basically 90% is just free cash, and then the rest they send back to the business, right? To building new offices, to developing new games. These two add up into the capex. Amazing business. They have no debt, 0% debt. So it's how can you go bankrupt without debt, really? So they have a huge, strong balance sheet, and obviously a global presence. So even with Europe kind of tanking here for the second quarter due to UK issues and some ring fencing going around on regulated markets and what they have to do to please the regulators around that. Of course, this business has risks, so nothing's risk free. Regulations can change in markets. It can hurt you. Although I think operators are way more exposed to those, all the KYC and everything type of regulations. Actually, they have recently, I think in a couple of weeks, I'm filming it in early October. A couple of weeks ago, they had one of their Asian operator a license revoked. I think they have to stop operating in October 7. One of the operators in maybe Indonesia, but certainly Asia, because they didn't comply well enough with the KYC regulations. So they don't have an operational risk from that perspective, but their clients do. So that's still a risk for them. They have a sort of dependence of large operators, right? Like 40% of the top 50. We can check back the slides, but that's not killing the business type of issue. More companies have way larger exposure. And then they have risk around cybersecurity and IT disputes. So if somebody hacks into your live stream and uses it, and then maybe the UK wants to talk to you. Overall, I would put Evolution to still have an upside, considering today's prices versus the intrinsic value. They have no debt. They have huge return on tangible assets, unbelievable free cash flow margins. I think this is one in a lifetime business that you can invest in. And to get at this valuation, I used 12%. So if it grows 15%, it's even better. It's a compounder, right? It buys back shares. It has really low capital needs. It's just overall an insanely good business. That would be Evolution. Let me know in the comments. And please, if you enjoyed, like and subscribe. And let me know in the comments if you want me to look at some other companies you might like. Thank you and have a nice day. See ya.